let's go on to question number 9. Consolidated financial statements are typically prepared when one company has a controlling financial interest in another, except for, or if you will, unless, and you have 4 different instances. Stop your video, and then when you're come for your own solution, restart your video and look at the solution slide. Okay, number 9, consolidated financial statements are typically prepared when one company has a controlling financial interest in another unless, and the answer is C, the subsidiary is under the control of a trustee in bankruptcy. If you look at A or B, these are kind of nonsensical items because they really don't pertain to anything regarding business combinations. D looks like it could be true if 2 companies are in unrelated businesses, but the truth of the matter is that companies are consolidated all the time, even though their businesses aren't necessarily related. We still do consolidate them, so D is not correct. So the correct answer is C. The subsidiary is under the control of a trustee in bankruptcy. In this case, even if we can have a controlling interest, since a company is under the control of a bankruptcy trustee, it's up to the trustee to make the decisions ultimately about the business and the direction of the business. So let's go on now to number 10. Number 10, at the beginning of the current year, P Corporation acquired 100% of the outstanding common stock of S Corporation, and that amount was for $800,000. On the date of acquisition, the fair value of S's net identifiable assets was $820,000. The book value of S Corporation's net assets was $760,000. As a result of the acquisition, P Corp should recognize, and again we're given 4 choices. Go ahead and stop the video, and when you're ready with your choice, with your selection, go ahead and restart the video and view the solution slide. Okay, number 10, the question again is the book value of S Corporation's net assets was $760,000. Now, as a result of the acquisition, P Corp should recognize, so if we build up the calculations from the facts and the problem above, the consideration transferred was going to be $800,000 because P Corp acquired 100% of the outstanding common stock of S Corp for $800,000. Now we're told that the fair value of S Corp's net identifiable assets was $820,000. So we take the fair value of S Corporation's net assets and compare them to the consideration transferred, and what we ended up seeing here is that we actually paid $20,000 less than the fair value of the assets at the net assets at the acquisition date. So that represents a gain on a bargain purchase, and you can see the answer here, a gain on a bargain purchase. We don't really care about the book value or the carrying value of S Corporation's net assets because we only care about the carrying value. Okay, let's try number 11. On June the 1st, P Corporation acquired 40,000 shares of the common stock of S Corporation. 50,000 shares of S Corporation were issued and outstanding, so we didn't acquire 100% of the company. On the date of the acquisition, it was determined the fair value of the net identifiable assets was $800,000. In this case, the fair value of S's minority interest was calculated to be $175,000. So we don't really have to do a calculation on what the minority interest is. It's provided to us. What is the amount of the goodwill that should be recorded by P Corp at the date of acquisition? So again, stop the video, and when you're ready, restart the video and go on to the answer for number 11. Okay, in this case, what is the amount of goodwill that should be recorded by P Corp at the date of acquisition? Now, we're told that the value of the minority interest was $175,000. So, and we can also tell that we purchased 40,000 shares and there were 50,000 issued and outstanding, means there's 10,000 shares left. So that equates to that minority interest represents 20% of the company. So in order to calculate the full value of the company, so we can calculate the full value of the company simply by taking the $175,000 value of the minority interest and dividing it by the 20%, the interest of the minority shareholders. That means the total value of the company was $875,000. That's the amount of, in effect, the consideration. From that, we subtract the fair value of the net assets acquired at acquisition date, which are $800,000. So the $875,000 of consideration we paid compared to the fair value of the net assets at the time of acquisition of $800,000 means we compute a goodwill of $75,000, which is our answer B, $75,000. Okay, let's take a look at the final question, question number 12. And in this case, P Corporation purchased 70% of S Corporation's outstanding common stock for $490,000. S Corp's assets were equal to their carrying value of $750,000, except for one asset, which had a fair value actually $20,000 less than its carrying value. S Corp also had $200,000 of liabilities, which P Corp would assume. And again, what is the amount of goodwill to be recorded with this particular transaction? Again, stop the video. When you're ready with your answer, to review the answer slide, go ahead and restart the video. Okay, and the question here again, what is the amount of goodwill to be recorded with this transaction? And the answer in this case is B, $230,000. So we start off with the acquisition costs that we paid for 70% of the company. That would be $490,000 worth of consideration, and we bought 70% of the company, so we divide it by 0.7. So what happens is that the acquisition cost at 100% then, if we own 70% at $490,000, the acquisition total cost of the company would be $700,000. If we take the assets at their fair value, they're going to be $750,000. We do know one asset was $20,000 below its carrying value, so we subtract out the $20,000. So the fair value of assets being acquired would be $730,000 less the fair value of liabilities that we're assuming of $200,000. So the net assets acquired would be $530,000. Okay, effectively, if we purchased 100% of the company, we would have paid $700,000 for it. We compare that to the net assets acquired of $530,000, and in this case, we paid $230,000 more than the net assets that we acquired. So the answer in this case would be goodwill, $230,000. That would be B, $230,000. And with that, that's the end of accounting for business combinations.